Did you know that 68% of families experience financial hardship within 6 months of losing a primary breadwinner? Today we're diving into how life insurance can be a lifeline during such trying times. Stay tuned as we uncover personal stories and expert advice that you won't want to miss.
Well, I'd like to welcome everyone to the Money Mindset Mastery podcast. I'm your host, Jim. Joining me today is my co-host, Ryan. Ryan, how are you today?
It's wonderful that the rain has stopped. We have power again, and electronics are starting to work again, right? So, yeah. Hurricanes come through, it's gone. So,
yeah, and I think Ryan, you and I have kind of started off as Laurel and Hardy, and now we're the Three Stooges because it seems like Denis is now starting to join us on our podcast. So, Denis, how are you doing?
Doing well. Same reply as Ryan. We're starting to see some sun, and the rain, I think, may be over.
Yeah, we were actually without power today for 3 or 4 hours, so I couldn't even get the vehicle out of the garage. And anyways, we're back to normal again. But today we are going to be talking about, I would say, a serious topic. Not so much gloomy, but it's definitely necessary. And really, this one is about the life insurance lifelines and navigating death benefits and family support. A lot of people have an understanding of what the process is to get insurance. Unfortunately, there are people who also understand what the process is when you claim on a life insurance policy. And we kind of want to talk about that process. And what's prompted that, to be honest with everyone, is recently I just had a very close friend of mine pass away who had coverage, and I'm going to be assisting his family with the claims process and talk about what that process is, how it does help the family. I'll tell you right now, it's never going to ease the pain of losing a loved one, but it definitely does help eliminate some of the financial anxiety, specifically if the person that passed away was the major breadwinner in the family. So that's what we're going to be talking about today. We're going to try to keep it somewhat light, but it is a serious topic. We did talk about, the claims process on a critical illness policy, which was on me, which I had claimed on 5 years ago. Death benefit obviously is a little bit different. So, Ryan, why don't you lead us into understanding life insurance death benefits? Let's talk about that.
Yeah. So obviously, when you purchase a life insurance policy, the death benefit is obviously the portion that is going to the beneficiaries that are named on, whether it's individuals, states, potentially even a business. And it really allows the beneficiary. The primary reason the life insurance is really the death benefit, and that's the biggest thing, right? So, and really how it can help the beneficiaries after somebody's passed. Now, there are obviously different types of life insurance. There's life insurances that you can use within your lifetime too, but we're specifically talking about the death benefit when somebody's passed. And within these policies, obviously, whether it's permanent or term life insurance, term typically being a little cheaper than permanent life insurance, but it's a matter of what you can do with that money. Often the money comes tax-free, so depending on how it's structured. And then it's really important that you always update your beneficiaries. I always find clients don't have the beneficiaries updated. And if they're not up to date, then it will pass to the estate itself, which can create some problems at times when it's not properly done. And then, with that also not having a beneficiary named and going through the estate, there can be some tax implications that can come up too. So important is to make sure that the beneficiaries are updated, all the information is updated, and that your family members can find where these life insurance policies are upon the passing. And I think another thing that we talk about too is some of the misconceptions when it comes to life insurance and the death benefit. Obviously, some people only think that it's something for the elderly or that you strictly have dependents. but the death benefit for a lot of people, help cover the final expenses upon the person's passing. It takes away a lot of the financial stress that often people don't realize that happens when somebody passes. People look at it as too expensive. It's also looked at as based on your age, your health, or your lifestyle at that time. But it's the use in which that benefit can provide your family or your business, or, as we'll talk about, even charitable donations for the future. So that's really kind of a quick summary of kind of the death benefit and what it means to families or people receiving it. So
yeah, and I think I just kind of want to add to that a little bit in terms of the death benefit only benefiting the survivors. There's other ways that you can benefit from the death benefit while you're alive, and I'm just going to use some basic examples right now. So, for example, if you had $1 million portfolio that you were going to be drawing on in retirement, a lot of people don't spend down that asset because they don't know how long they're going to live. So they don't want to necessarily deplete it. So they will take a percentage of whatever the value is. So call it 5% of $1 million, $50,000 a year. But when you have a life insurance policy, you can go ahead and start depleting some of that capital, knowing full well that the death benefit will replace it when the person passes away. So it is a way of spending down your death benefit while you're alive. So that's just definitely one of the points that I wanted to make. Denise, let's talk about the process of claiming on a life insurance death benefit.
Well, I think as a financial planner, I think the process can be easy, but it can be different as well. When you're settling, it depends who the beneficiary is and how you want that spread. Now, I speak to a lot of clients where they want to put their kids as beneficiaries. Some of them may be minor kids. So there is a process where you can set up a trust with the life insurance proceeds for your kids. So that's a process that you probably want a little more detail. Who's going to follow it? Who's going to be a trustee on it? How's the money going to be spent? Do they get all the money when they get, they turn 25, 18, just when? So that's a little different. The other way of settling a life insurance can be if you put the beneficiary as the estate. Now, the estate sometimes is the beneficiary if you have a lot of taxes within the estate to be paid. So it goes in there, and it's really just to pay off the taxes, because the RSP may pass outside the will, but the taxes need to be paid by the final death terminal tax, basically. So the beneficiary may not pay it, but the estate will pay it. So that's why. Do you need money within the estate to pay it? As you know, if there's no money within the estate to pay taxes on an RSP, then they will go after the beneficiary. The CRA will go after the beneficiary. So that is key as well. The one negative thing about putting it through the estate, it will go through probate. So you will pay a tax on it. The probate in Ontario is 1.5, one of the highest, 1.4 in BC. They're not too far behind. You have an executor involved. When you go to the probate, of course, the probate whole experience is to validate the will. So once that's validated and the executor can take over, he has the authority now to take over the assets. So that's a little the process that happens if it has to go through the will and life insurance. So there's a lot of ways to deal with it. You could get the cash. It's very simple when it comes to if you just want the death benefit. Basically your death certificate, and you go to the insurance company with their various forms, and then you could get the cash. When it goes through the will, through the estate, it's a little different and can be a little more cumbersome, but if that's best for the client, then that's the way it needs to be done.
Yeah, most insurance companies, from a claims process, all they require is a original copy of the death certificate. And normally the funeral homes will provide 10 to 12 copies. And if you need more, obviously you can request more. And then, again, depending on the amount of the death benefit, usually just a claimant statement is also completed and signed and submitted. And what I would say, my experience in turnaround time is once the insurance companies receive all the claimant statements, so let's assume there's more than one beneficiary named, they will wait until they receive all the claimant statements to then issue the payouts. And the payouts usually will happen within 5 to 10 business days of the insurance company receiving all the claimant statements with the death certificate. So it is fairly quick.
Mhm.
And also to note that the death benefit in most cases is paid out tax-free as well. So that is received by the beneficiaries tax-free. And if it doesn't flow through the estate and you've named a beneficiary, then again, they receive those proceeds directly. So just a couple of things I want to point out there as well. Let me just see here. Is there anything else to talk about? Oh, yeah. Where a life insurance policy really is beneficial. So then we'll talk about the RSP, for example. I don't know how many individuals that I speak with don't quite understand the tax consequences of passing away with an RSP, LIRA, or a RIF. And then when we walk them through the process and they find out if they pass away, for example, with a $500,000 account, assuming there's no spouse to name as beneficiary, and it gets, and it's a child or anybody else outside of a spouse that gets named as a beneficiary, then that account is fully taxable. So CRA will basically add that, call a $500,000 registered account. They would treat it as if it was fully cashed out the day before the individual passed away. And on average, we're looking at about half of that going to taxes and the other half going to the beneficiaries. So one way to pass that tax bill on is by buying a life insurance policy for $250,000 coverage in this example. And when the person passes away, they're still going to pay the tax on the RSP, but it'll be replenished by the tax-free death benefit from the life insurance policy. And then some people will ask the question, and Ryan, you've been in meetings with me where they're like, well, it's too expensive. Why would I do that? Well, if you have to pay a $250,000 tax bill, it's going to cost you $250,000 to pay it.
Yeah.
But if you have a life insurance policy, even if you've paid $150,000 in premium to pay out that $250,000 death benefit, it only costs you $150,000 to pay that $250,000 tax bill.
Yeah.
Right. So usually it's cheaper to have the insurance company take that responsibility than for you to use your own assets. It's always going to cost more to use your own assets. So just a little bit of basic planning there when it comes to insurance.
And I would add also the insurance helps protect the families after when they're trying to organize everything, final expenses, paying off any debts, preparing all this information for the CR, potentially hiring somebody to help them do it, because it is not an easy job, and it's quite stressful for the individual, especially they've never been the person that does this. To have that insurance policy, and I've seen the insurance payout happen in 2 or 3 business days, usually on lower amounts. But I've also seen the effect that it has on a family when they have nothing in place. And it will get dragged on. I have clients and I've had friends that it's dragged on well over 2 years because there's so much to do. And you're trying to go upon your day-to-day. If you're a parent taking care of somebody else, you're trying to go to work and also at the same time do these things. So it's nice to have that kind of assurance to get you through the day-to-day and pass on some of that to experts, right? So I just wanted to add that.
So I'm going to talk about, I guess, my very first time that I had to assist a client with processing a death claim. It was actually fairly early on in my career as an independent advisor. I was at the time working with a senior advisor, so I was his junior. This was a client of his, and he thought it'd be a great learning experience for me to actually go through the process of submitting this claim and going through the steps. And just to kind of step back a little bit, so what had happened was the client in particular that I was working with at the time, so this was a little over 20 years ago, wife who had 2 kids under the age of 10. She worked at the Toronto Star. Her husband at the time was diagnosed with Lou Gehrig's disease in his early 40s and was actually in a long-term care facility. What had happened was this client had a life insurance policy, a 10-year term policy that was coming up for renewal. She had $140,000 coverage, and the renewal premium was going to be very expensive. So I reran the quote, and we replaced that policy with a new 10-year term policy for the same coverage, $140,000, and I believe it was like $27 and change for the monthly premium. And this was right before Christmas time that we started the process. I remember when I asked her about setting up the beneficiary designations, on her original policy, she had her husband as the beneficiary. And again, he was in long-term care facility, couldn't communicate with Lou Gehrig's disease, had less than 2 years left to live. And she had named, we were looking at naming a trustee in trust for the 2 boys. And she had said to me, Jim, you know what? I'm just going to wait till my husband passes away, and then I'll make those changes at the time, even though I recommended that she do something different. So we kept the beneficiary designation as it was, right, with her husband as the beneficiary. Now, this was all before Christmas. I had her new policy was issued. I had called her, said, great news, policy's issued. Let's get together to complete the transaction. And she'd asked if we could wait till after Christmas because it was like really busy time, and she was hoping that we can just wait till afterwards. Now, I knew because she didn't pay me the first month's premium, she wouldn't have had any temporary coverage. So I just let her know. I said, you know what? It's going to take me 10 minutes. I'll come in, get your signature, write me a check. You'll be officially covered. And then we'll go ahead and we'll submit the cancellation. Once a new policy's in place and we've confirmed that, we'll go ahead and cancel your old policy. So she agreed to it. I believe it was like December the 23rd that we got together. Went in 10 minutes, had everything all signed off on, had her sign the cancellation letter as well. And that was done. She was now officially covered under the new policy. New Year happens, first business day back. We have a voicemail from my client's sister. And during Christmas, her and her boys had gone to visit family in Kingston, Ontario. She was snow tubing, and her snow tube went off track, and she went head on into a snowmobile, a park snowmobile, and died instantly. Done. So now I had to submit the claim on this new life insurance policy. And I had to deal with someone who couldn't communicate with me. Because again, he had Lou Gehrig's disease. He was named as a beneficiary. So that was very difficult in terms of the process. But before I talk about the difficulty of the process, I do want to share some good news, because whenever we hear news about insurance companies, you always hear the bad stuff that happens when they deny claims and whatever else. This is what I'm going to share with you because I want people to know this. So the new insurance company that we placed the policy with, they paid out the $140,000 right fairly quickly, and they also refunded the $27 first month premium. Now, the insurance company that we canceled the policy with, and this is what blew me away, they knew she had passed away because it was actually reported in the Toronto Star. So they were aware that she had passed away. They had a faxed copy of the cancellation letter, and they had the date, which was before she passed away. So technically, the policy should have been canceled on the 23rd of December. They came back, and I don't like naming insurance companies, but at the time it was Norwich Union. They're no longer in existence, but it was Norwich Union who we canceled the policy with. They came back and they said, we have an internal policy here. We don't accept cancellations through faxes. We accept them with originals. So even though we know that there is a letter signed December the 23rd to cancel this policy, Because we received it by fax, we will honor the $140,000 policy that was to be canceled. They didn't have to do that. And they went out and did that. So now the family, the beneficiary, received $280,000 when they were expecting only the 140, right? So I wanted to share that with people because, again, we always hear the bad news and all the declines and whatever else, but insurance companies do a lot of good, and we need to share that. The difficulty with this whole situation was I now had to deal with, again, the husband who survived. What he did was he had a sister out in the East Coast. He decided for his sister and brother-in-law to move from the East Coast to move here in Ontario to help raise his two boys because he couldn't. He just wasn't able to because he was in long-term care facility. Because of that, I started to see the $280,000 dwindle rapidly. Money that was intended for the two boys disappeared in less than 12 months. Because what was happening was the sister, who wasn't good with money to begin with, who now had access to $280,000, she would come and say, you know what? My vehicle won't fit us all. So now I have to buy a new minivan. And she'd use the money from the proceeds to buy a new minivan. Then it would be like, I want to take the boys to Disneyland, but I can't just take them. I have to take my kids as well. And of course, we have to chaperone them. So they would pull the money from the proceeds to pay for this big, huge, lavish trip down to Disneyland for the entire family. And it just kept on happening repeatedly. So by the end of it all, the boys had nothing left over. That is why when I do have clients ask about naming beneficiaries and trust and trustees and all that, normally I do recommend make the guardian separate from the trustee of the funds. The guardian can take care of the kids, but have someone separate who's responsible for the funds. That way the guardian will have to go to the trustee and justify the reason for those funds, and the trustee ultimately will have to make that decision if it makes sense or not. That definitely was a learning experience for me. But it was a very emotional time because I knew what was happening with the money and I knew what the intentions were, and there was nothing that I could do about it. So that was my first experience.
Always important to regularly review who you assign as trustee, beneficiaries. If anything changes where you may not find the trustee is the appropriate person, make that change and don't wait. That's a perfect example. Your story is a perfect example of why that should be the case.
Yeah, and the other thing too is whenever someone thinks about naming a guardian for their children, they're always going to think about someone that would take good care of them. Mm-hmm. What they should also consider in naming the trustee who's managing the funds is someone who's good with money or reasonably good with money, right? If you name a trustee and you know that they're big spenders and they're constantly in major debt and there's constantly in financial hardship, probably shouldn't be naming them as a trustee of the funds, right? So that was definitely a learning experience, a very difficult one to kind of get through. The next one,
I was going to say,
go ahead.
As far as payouts go too, like in my experience, I've never had one rejected. The only ones that I've heard is usually through a U.S. story, somebody who, whether they've watched television or they watch a movie and they have this like auto insurance, life insurance is very different because of the underwriting process. And I think that's one of the biggest things. If you don't go through an underwriting process with the insurance company, because there's a lot of companies out there that waive the simple applications and stuff like that don't go through a full application. Yeah, those stories are there. It happens. It's because somebody either lied on the application or that the underwriting process was not done. And for those underwriting processes that I've talked to many other advisors, insurance companies, is like, most of the insurance companies that I've worked with, I think they all have like a 98% payout rate, and that extra 2% breaks down to ones that were still being processed and a percentage of ones that were falsified in the application process. So kind of an understand. So for me, it's where are these stories coming from? Are they coming from the US? Because that's a different beast. We're talking about in Canadian insurance companies, the payout is often very close to 100%, between the 98 and 100% mark, right? I've never had an experience where somebody hasn't not been paid going through. I don't know if you guys have been in the business much longer than I have, but people's
only
fears
story.
always
Well,
they've
there
not
is a
paid.
story. There is a story of one when I first started in the business, and they talked about it.
Mhm.
So it was Gagnon Sports, which was not too far from me here in Oshawa. The owner of Gagnon Sports, the store got robbed, and they murdered him. They shot him, murdered him, left him in the ditch, passed away. His wife went to go ahead and submit the claim on his life insurance policy. At the time, he had insurance with Metropolitan Life Insurance, which is no longer in Canada. Metropolitan Life Insurance at the time was one of those really cheap insurance policies. They didn't really do a lot of their underwriting up front. The underwriting happened at time of claim.
Yeah.
So now they started the underwriting process on this $1 million life insurance policy. The wife's husband just got murdered, and she's expecting $1 million payout, and Metropolitan Life declined the claim. The reason why they declined the claim was he had had a heart attack, I believe it was 12 months before he bought the insurance policy. And on the application, it was indicated that he never had an issue with his heart. What we don't know is, did he disclose it and the agent decided not to put that in there knowing that he would probably get declined? Or did the client, like you said, fraud, basically said, no, I'm fine. But it was uncovered during the claims process, during underwriting, that he in fact did have a heart attack, which means the policy was null and void. It didn't exist because they never would have issued the policy had they known that he had a heart attack 12 months prior.
Yeah.
The wife sued Metropolitan Life. It went all the way to the Supreme Court of Canada, and the Supreme Court of Canada sided with the insurance company. Because what people don't understand is a life insurance policy is in fact a contract. And there's a contract between you and the life insurance company. And the Supreme Court of Canada came out and basically stated he falsified. He didn't answer the questions honestly. Had he indicated that, yes, he did have a heart attack 12 months prior, the policy wouldn't have been issued to begin with. And it was null and void. So that's one example that I know of. I believe that happened in the 80s, early 90s. You don't hear about that too much now, but what you do hear more of now, and we haven't experienced it, but I do hear the stories in the industry, people who say, I'm not a smoker, because they don't want to pay smoker rates.
Yeah.
And then they die. And then the insurance company starts looking at social media profiles. And they see pictures of that individual actually smoking cigarettes or marijuana or whatever during the time that they did the application. Now, in that case, some insurance companies will turn around and say, outright decline, we're not paying out the death benefit because he was or she was a smoker, but they stated that they were a non-smoker at the time, so they lied. Some of them will actually readjust the death benefit. So what they'll do is they'll calculate it as if it was what the premium would have been as a smoker rate, and they pay out a reduced amount. And some insurance companies will just, again, not pay out the death benefit or refund all the premiums, right? So there are some examples, and that's why I always say to every client, when you get the phone call to go through the health questions, be honest. Like, tell them everything that you're aware of.
Yeah.
If there's something that you're unaware of, that's different. But be honest with them. If you say a single cigarette over a 12-month period, yes, you're going to be treated as a smoker, but disclose, because if you don't, you pass away, and they find out that you actually did have an occasional cigarette during that period of time, your family's not getting the payout that they were expecting. Right?
Mhm.
So,
sorry, I just wanted to squash the misconception that people have had of all these insurance policies that never get paid out. but no one actually has the proof. But again, as you said, whether it's somebody that's lied on an application, potentially an advisor that's put the check mark somewhere, and or you haven't gone through the underwriting process. If you haven't gone through, and there's some mortgage insurances that do that, as an example, they have a very poor payout rate. So I don't know what the number is, but it's very poor. So
it's quite high because before I became an insurance advisor, I was a banker, as many people know, and the call center that I worked at, my department was next to the mortgage life insurance department, and it was decline, decline, decline. And it wasn't for non-disclosure from the client's point of view. It was more ignorance, not understanding what the question was. Right. Yeah. So, for example, there could be a general question: any cardiovascular issues? Client says no. Then they go ahead and submit the claim, and they find out that they were taking a statin drug. And the insurance company, the bank insurance company, comes back and says, "Sorry, that's a cardiovascular event. You said no, but that should have been a yes. Decline." Yeah. No one equates taking statin drugs and cholesterol with a cardiovascular event, right? But it's just those little nuances in the question that throws people off. And CBC Marketplace has done a couple of exposés on mortgage insurance and credit insurance in general, and why you should try to get your own individual policy. Another one is group insurance. Like, how many times have we gone through a full plan with a client, and they tell us, "Oh yeah, I have $100,000 in my group plan," and we're like, "We're not going to even include that because you don't own it. It's not yours, and it could be taken away. You can leave your employer and not have coverage under a new employer, right?" So we don't even incorporate any group benefits when we do our planning because the client technically doesn't own it. Yeah. So let me talk about, I guess, my second. I've had a few death benefit claims throughout I've been doing this for 35 years now as of June. So for sure, I definitely, there's a lot of claims that I've gone through, but the first one was definitely the one that I'll never forget. And now this one here is because of a close friend of mine. We haven't started the process yet. But I just know when he came to me about 8 years ago, we went through a proper insurance assessment. It wasn't, yeah, we're just going to get you 250 coverage or 500. It just wasn't enough. So I walked them through a proper insurance analysis and assessment to determine how much coverage he should have. And part of the consideration was, because he was the main breadwinner in the family, that if he were to predecease at a young age, the family would lose out his revenue, his income, and we'd have to somehow replace that. Yeah. And I remember when I went through the process with him, and again, in his mind, he thought, yeah, probably $500,000, $750,000. It was definitely a lot higher than that, and he was shocked. And it was explaining to him, okay, well, you pass away, your family loses a source of income. We need money set aside so they can draw from that. So at the end of it, he agreed to move forward with the recommended amount. And now he's passed away at a young age, just a few years older than me. He leaves a family behind. What I do know is that when I deliver the death benefit, again, it's not going to erase the pain of the loss of this individual who's a wonderful human being. But some of the financial anxiety that the family would be facing right now, thinking, how are we going to survive? Do we have to sell our house now? Do we have to start cashing out a bunch of investment assets to live? They won't have to worry about any of that because they're going to receive this death benefit tax-free that's going to buy them some time to grieve properly as well. That's the other thing. They don't have to now rush to figure out, do I need to go and get a job now? They don't have to worry about any of those things. They can take some time knowing that this money is set aside. Financially, there's no concern. And they can just grieve the loss of this wonderful human being. And all we need, again, is a death certificate and a claimant statement. Now, because I knew about his passing, I was able to reach out to the insurance company right away, letting them know individual passed away. Here's the obituary, because sometimes they'll actually ask for that. And they've already started the process, the claims process, without me reaching out to the family yet. Once they're ready to deal with this, we're set to go.
Mhm.
We're good to go. And then I guess the question then comes, Denis, what do people do with that death benefit? Like when they receive a significant amount? Then what tends to happen is you have people, the bank, for example, that money is going to get deposited into a bank. And we all know, all three of us here, there's going to be a banker calling right away.
Suddenly they're best friends. Yeah.
And let's start, depending on the amount, you're either dealing with someone within the branch who's going to sell you a whole bunch of mutual funds, or they might refer you to someone outside of the branch who's more specialized portfolio manager, but it's still going to be a stock and bond portfolio and potentially at a much higher risk than the person should be dealing with. And they're going to be overwhelmed because, again, they've dealt with the loss of this individual. They're dealing with now having to move forward without this individual. And now they've received this lump sum of money, and what do they do with it? And that's, Denis, where you potentially come in.
Yeah, and I think you hit some good points on this. If you do a proper needs analysis, you have a financial plan, you get the amount needed. Now, it's the amount needed is key because I'll share an example a little later, but the amount is key because once you have those two numbers and somebody does pass away, you should have a good idea of what you're going to do with the money. Pay off debt, set up your own pension plan, RSP, and put in money. So the plan should already be in place if you have a financial planner, a good advisor, you have the right amount that you needed, because on a financial plan and a needs analysis, it'll tell you what the money is going to be used for. So that's going to be key. After that, if you could look at your own risk levels and how to invest it, pay off the debt first, especially if it's high debt, to make sure, because you're potentially losing a breadwinner. So pay off that debt so it's not, overbearing based on potentially your salary if you're still working, if you're retired. You don't want a debt payment based on what you're getting as a pension. So that's key. And the one thing I mentioned on needs analysis, in my own example, I'm actually going to use the death of my own father at 52. So it was an accident. It was sudden. There was insurance in place. It wasn't a big amount, but it met my mother's needs. Now, the insurance actually advised at the time was quite good because in 1989-90, interest rates were quite high. So he suggested an annuity. We invested that in an annuity, and it gave comfort to my mother. Money's going to be coming in. I think we had it set up till 75. Money's going to be coming in no matter what. Because my father was not retired yet, he basically lost his defined benefit pension plan. So there was no getting 60% of that. He was going to retire in about 3 or 4 years. That did not happen. So that is completely out of any plan. Obviously, the income for those final years is out of the plan. That's why the insurance plays an important part. Sure, the company paid, I think that my mother was 55. They paid her a sum, 55 or 60. One or the other. But it basically, after that, it was over, and she was on her own. She was on her own getting CPP survivor. So the actual annuity really helped. She had used her own defined benefit as she was a city worker because they wanted to pay off the mortgage. Not something I would recommend, but they did it and they didn't have any debt. So small amount, but with no debt, it made the comfort that money would still be coming in. There's the pain of the accident, because it's a big difference when somebody dies unexpectedly than, taking that time. And we all know somebody that got diagnosed 8 months later or a year later, they may have passed, or you're at that certain age where they think you're going to go anyways. When it's an accident, you got to be prepared because there's no time to change anything. And even if you were older, I meant to add a comment before on making changes on beneficiary and how important the accuracy is. If you suddenly become incapacitated, the time to make changes are over. They will not allow you to make a change. They will not allow your power of attorney for health to make a change. That is set in stone unless you're going to really fight it in court, which really nobody really wants to do, and you're not you're probably not going to win anyway. So it's always important to get it in place in case something happens tomorrow. Not I'm not going to die now. I'm only 55. Talk to me when I'm 75. No, get things in place now. That's
And
what's
let's
the
talk
importance.
about timing too. Just to say, like, beneficiary change. You send us the names, the breakdown. We send you the form. You sign it. It's all of 3 minutes, really, when it comes down to like 3 minutes of your time, no matter how busy you are. Can you spare 3 minutes to make sure that the beneficiary is going to the right people at the right time, whether it's through the estate or a plan, right? People keep pushing
And
this
there's
off.
no cost.
And there's no
cost.
cost.
No cost.
Right? 3 minutes, probably less than that, to simply send us an email. These are the changes to my beneficiary. We send you the paperwork within a couple hours. You sign it off, and we submit it for you, and that's it. And the number of people that I've worked with, even in my 6 or 7 years doing this, the number of people who push it off, that ends up like a situation like Jim you just explained. Please, beneficiaries, update. The best way you can avoid all of this. So, and the heartache of your family because you're gone. So, yeah.
And name those beneficiaries directly on the insurance policy, because the bottom line is, even if you make those changes on your will, the insurance company is going to mostly write the check to whoever they have listed on their records. And then you have to go through the process of providing them with your will to show them that this will was actually changed on such and such a day. This is when the beneficiaries were set within the will, right? So it does delay the process. So just name them directly on the insurance policy. That'll just save you a lot of time and hassles.
And it's private
and
too.
review it on a regular basis too. If you have your kids in there when they were minors, if they're now in their 20s, don't have a trust set up. Make those changes. If you have your spouse there and they pass before you, make sure you make that change. For whatever reason, you could change your beneficiaries on your kids, your husband. If you're divorced, take a look at that. Is that still appropriate? Always take the time to make the review on not only the insurance but all your plans for beneficiary.
Yeah, I don't know how many times I've reviewed a person's pension, for example, and they're remarried, and I would see that the former spouse was listed as the beneficiary. And I'm like, is this something that you were required to do? And they're like, no, I just never thought about changing it. I'm like, well, you need to go ahead and make that change, right? So again, working with a team of professionals, we're going to help you and identify those gaps or those potential problems. So, and I think as we kind of start to close this, wind this down a little bit, Ryan, I believe, and I learned this a long time ago from that senior advisor, so I definitely will give him credit for this, where he said the most important thing is you have to make sure the person has the right amount of coverage. Because the bottom line, when I worked for the career insurance company, and I'm not going to name names, they always taught us sell the premium. What can they afford? Sell them whatever that will buy for them, right? And the senior advisor kind of had to scrub some of that training from me, kind of like I had to do with you, Ryan, when you came from similar company. And he said to me, he goes, listen, the bottom line is this. If you sell them what the premium could afford, and that individual walks out the door the next day and they get hit by a car, what financial situation is that going to put the family in?
Yeah.
If there's a significant shortfall? What you want to do is you want to make sure that you provide them with the right amount of coverage that's required, and you adjust the type of product offering as a result, because then you know if that same individual the next day walks out the door, gets hit by a car, and passes away, from a financial point of view, the family's covered. They don't have to worry about selling homes and whatever else, right? So that's really important. And here's an objection before you say your piece, Ryan. An objection. I just want to mention this now that I'm thinking about it. I don't know how many times I've sat down with clients, usually it would be a married couple, and I would say, here's the amount of insurance that you need. And usually it's the husband who would say, you know what? She can just sell the house or she can just sell the rental property and she'll be fine.
Mm.
Well, if you died in the last 12 months or so and you're dealing with the current real estate market right now, you're going to have a problem because real estate is not selling. And if it is selling, it's selling at a discount because of the industry, the market that we're in right now. Your plan of just, hey, she can just sell the house. There are houses that have been sitting for 6 months now. What does that survivor do in the interim? Make sure you get the proper coverage and don't rely on some of these other assets.
For myself, I look at my son, and when you're sitting down with two partners and whether they have dogs or family, is what is the standard of living you want that person to have, right? And again, when it comes down to what's the standard of living I want Walker to have, do I want it to be less than what it currently is, the same, or better, right? Hopefully the answer is same or better. And that's one of the biggest things people like. We do the needs analysis so you understand all the possible outcomes that could happen, right? It's just simply for awareness. This is what could potentially happen. But if you think about somebody in your life, because I know you know somebody in your life that was now a single parent, what is their life like, especially when that person did not do proper planning? And I know at least 4 or 5 people, and it's typically the female that continues to live. They are struggling. They are all struggling. And, as I guess a dad, I don't want my son, or I wouldn't want my partner to struggle. I know I'm gone, so, I could say whatever, but I think people forget that, and they look at the number, well, it's way too much money, or for coverage that doesn't make sense. And there's a lot of people that push just small coverages, but I just think about what's the standard of living that I want my son to have going forward, and if I want him to be better off, because the Rockefellers and all those ones have definitely set their families generational to have a higher standard of living than the one before theirs, simply based on making sure that they had the right amount of insurance as a basic. So,
and speaking to that needs analysis and making sure that people have enough coverage, I think this is where I want to spotlight. We talk about robo-advisor platforms on the investment side and how there's limitations there. There are people who are buying insurance policies online through these online providers, and they're not going through a needs analysis. Now, they do provide a calculator, so the individual can plug in some numbers if they choose to determine how much insurance coverage they should have. But there have been a few instances in the last couple of years where I've sat down with clients where I've gone through a proper insurance plan, and I look at the amount of coverage that they have, and usually they only have about a third of what they actually really need. And they bought their policy through an online provider, and I'd ask them the question, like, didn't you go through some kind of assessment? No, I just thought this was the amount, and this is what they put me through for, and that's what I qualified for, and that's what I bought. No one really walked them through a proper analysis to determine if that was the appropriate amount of coverage for them, right? Mm-hmm. So keep in mind, you want to deal with an online provider, you're going to be limited in terms of the type of advice that you receive. You want to know how much coverage you should actually have, your family should have. Speak with a professional that will walk you through that whole entire process.
And then, not to go too far down the rabbit hole of, which we talked about, when somebody receives a large sum of money, having the right people around you to help you make the right decisions, because the comparable really is when people win the lottery, right? Mm-hmm. Every article, every study you've ever seen, people who win the lottery, and that's very much what this can be like, which is you receive, you're worse off. Within 3 years, you're worse off than you were before without proper planning. So it's something to keep in mind as working with the proper team to make sure that all the planning has happened, how the money is distributed, whether it's children's education, paying off a portion of a mortgage, setting up and making sure TFSAs are maximized, setting up annuities, whatever it is, and that you're actually diversifying how that money is being used. And that way it's lasting longer, taking care of your expenses, and you can enjoy life. My experience with is that the times that I've had to do death benefit claims, they've all been positive experiences, and each and every individual has always, I can think of this one woman, for instance, lived out the dream of the travel that the two of them had planned, like something out of the movie Up, right? Being able to go and travel the world the way that they had initially planned, and being able to live that experience because that's what their partner would have wanted. So, yeah.
So I think, guys, to maybe summarize some of the takeaways for people, one of the most important things that I think we've identified, we all three of us agree on, is make sure you go through a proper analysis and have the appropriate amount of coverage in place. I think another thing that's important is make sure that you have the right type of insurance product. And there's a lot of different insurance products with a lot of different insurance providers. We're insurance brokers, so we can definitely assist with that process. Making sure that your beneficiary designations are set up properly. Review as well. Those are really important things. Anything else you guys want to add to kind of close?
No, the only thing I would say, the only thing I would say is that communication is key. If you have a partner, both should know what's going to happen to the proceeds after, and goals and how to use it, because one of them is going to be left to actually put all that in place afterwards. You want them to make sure that it is put in place according to both really their goals, and not make it as a lottery or spend it unwisely, and then the education for the kids may not be there, the money for the education, because you spent it somewhere else. That's the only thing. Communication is key, and make sure that you have already a plan before anything happens of how that money's going to be used.
Yeah,
Ryan, how about you?
You hit nail on the head as far as beneficiaries being named properly. And to me, communication with your family. This is the hardest conversation to have with your family. And I know, having this conversation with my parents, everybody gets choked up about it because it's a scary thing to talk about. But if you don't ever talk about it, what happens after it can be way worse. It is way worse. When you don't talk about it, you don't have a plan in place, that you don't talk about the fact that we will not, at this current time, live forever. But making sure that those things are being talked about with you and your partner, with your kids, with specific people that are important to the decision-making piece, whether it's advisors, other family members that are trustees. I know people that appoint trustees, or appoint, God forbid, two parents pass and the children, making sure that all those things are talked about, because it's a real shock to somebody that suddenly realizes, oh, I'm responsible for all this information. So communication through all of this. And when you have a great team like we have at TVH, then a lot of these things get answered and solved, and you're not pushing it down the road, because a lot of it can happen in a bunch of small, quick conversations. 1 minute of your time will help your beneficiaries. 30 minutes of your time can start the planning process. A couple hours of your family time can have like a real solid plan in place. So,
and if you have insurance policy in place, tell a trusted person that you have one, where they can access the information to if something were to happen to you, or at the very least list it in your will, so that way the executor will know that there are these insurance policies, and reference the policy number of the insurance company, as opposed to not telling anyone, and then they'd have to kind of check your mail for a statement, and all of a sudden 6 months later realize, oh, what's this? Oh, there's an insurance policy, and let's go with the claim. Notify people, let them know. Right?
Very quick. I sat in a room with a lovely client who's unfortunate partner passed away, and she had no idea where anything was, and mountains of paperwork and invoices. And I spent almost 2 hours with her going through and understanding each and every individual piece. And again, a lot of stress came off of her because she felt very overwhelmed. But we broke up the meetings into small amounts that she could understand, and over the course of 2 hours, everything was smooth again. So, yeah. Anyway.
So, guys, we always say that we're going to keep these within 20 minutes. We're at 55.
So
we're gonna wind this up. But bottom line is, if you're looking for some information, if you're looking for some help, if you're looking for a portfolio manager, you can find Denis at tvhwealth.ca, or you can email info@tvhwealth.ca, or even look up TVH Wealth on the social media platforms. And there's Facebook, LinkedIn. So that's one way to reach out to Denis. In terms of Ryan and I, tvhfinancial.ca or financial@tvhgroup.ca. And once again, you can look up in our social media platforms and you'll find us on all the big ones. So if you have any questions, if you want to just send us a quick email, if you do want to comment on any of our platforms, feel free to do so. And guys, have a wonderful rest of the day. I think today was a really important episode that we've recorded with a lot of information. And I'm looking forward to the next one in the next couple of weeks. Yep. Everyone take care.
Why is it me? Why am I God? I still